The second situation is when performance obligation to deliver goods or service over a period of time. So revenue is recognized over a period of time if one of the three conditions are met. The first condition is when the customer receives and consumes the benefit of seller's work as it is performed. The second condition is the customer controls the asset as it is created or enhanced. And the third condition is the seller is creating an asset that has no alternative use to the seller. And either the customer receives benefit as the seller performs, and therefore for the task would not need to be reperformed, or the company has a right to payment and the right is enforceable. So an example to the first condition is, for example, if you live in the university dorm and you are hiring a cleaning company to clean your dorm every week, and then you signed a contract with the cleaning company for 1 semester. So for the cleaning company, they can recognize revenue over time as the cleaning service is performed to you every week. That is an example of the first condition. An example of the second condition is the customer controls the asset. So an example is, for example, our school is building an extension to an existing building. And as the contractor is building the extension onto our existing building, they can gradually recognize their revenue. And then an example for the third condition is customer flight jet created for US Air Force. It has no alternative use to the seller. So that's an example to the third condition. But if any of these three conditions is met, we can recognize revenue over time and in proportion to the amount of performance obligation that has been satisfied. So let's look at an example. Company A sells 1-year subscriptions to internet-based games. Company A sells 1,000 subscriptions for 60 each on January 1st, 2016. And this is a 1-year subscription for internet-based game. How should company recognize revenue for this sale? Please take 5 minutes, try to write out your journal entries, and you can pause your video for now. So how should company recognize revenue for these sales? On January 1st, 2016, that is when company A sells this 1-year subscription for $60. At this time, has company A performed anything yet? No, it hasn't provided any service yet. So can company A recognize it has revenue yet? The answer is no, because the performance obligation hasn't been satisfied at all. The company hasn't performed anything. It just sold this subscription, and the company A has an obligation to perform the service in the next 1 year over time. So the general entry here is to debit cash because company A gets cash and it sold 1,000 subscription for 60 each. So the total amount of cash company A gets on this date is 60,000. And credit deferred revenue for 60,000. What is deferred revenue? Is it an asset or liability? Deferred revenue, it is not a revenue. It is a liability for company A. So company A, on January 1st, 2016, company A get cash. And at the same time, company A has a liability to perform service over the next 1 year. So that is a liability for company A. At that time, company A cannot recognize it as revenue, and because it gets cash, it needs to record a liability at the same time. And deferred revenue is a liability. And then, so how about if the company is it's closing its book at the end of every month. So at the end of each of the 12 months following the sale, which means that on January 31st, that is company A's next journal entry. And at that time, company A can, because company A has already performed 1 month of service, so company A can recognize the sales revenue associated with that month. So that's when we reverse this liability. So we debit deferred revenue 60,000 divided by 12. So that is 5,000. And to credit service revenue for 5,000. And then company A needs to repeat this journal entry at the end of every month in the following year. So this on January 31st, that's company A's first journal entry. And then on February, if the end of February is February, for example, 30th, for example, that will be company A's next journal entry. And then the next one will be March 31st. So it goes on and on for a year. At the end of every month, the company A can recognize when 12th of the 60,000 deferred revenue into a service revenue. So that is an example of recognized revenue over time. And to recognize revenue over time, a seller needs to do some kind of estimation. And the estimation we're doing in the previous example is the assumption that is made is the service provided, it is kind of unified, distributed over time. So every month, the seller is performing the same amount of service. And in general, we have 2 methods to estimate progress towards completion. The first one is output-based estimation. So we measure it as the proportion of goods or service transferred to date. And then the second kind of method is input-based estimation. We measure as the proportion of effort expended thus far relative to the total effort estimated to satisfy the performance obligation. So those are 2 ways to estimate what is the proportion of total revenue that can be recognized gradually over time.